Financially raw, real, authentic wisdom with Lawrence Oberholzer from Retire Rich and Happy.
Good morning, everyone, and welcome to another episode of Financially Raw. It is Thursday morning at 10 a.m. Can't believe another week has gone past. Last week, we discussed a little bit of the problems in the financial services industry, and we'll definitely revisit that. I'll get Yapi in. It was very well received. We got a lot of positive feedback on the discussion, so we will definitely get Yapi back to come and chat to us. Today I'm alone in studio, so it's just me and you, and we're going to have a nice hour of talking about everything money. So please keep me company. For those of you on our website, please, let me just switch this off a little bit. Please give me a shout out if you are on the Berg Studio website. Let me know you are there. And if you have any questions or any comments, you are welcome to make those comments to me, and I will try my best to answer your questions as well. The topic for today is going to be all about structured investment products. We're going to talk a little bit about what the kind of investments are that most people invest in, what the pros are, the cons are, the problems you might face, and how these things work. So we're going to talk about retirement annuities, endowments, unit trusts, exchange traded funds, tax-free savings. So there is a lot that we're going to talk about today. Hopefully I can get through everything in this hour. I will try my best. If not, we will have a follow-up session on investments and then continue the conversation. So yes, guys, we're going to talk about all things investment today, and specifically structured investments. So we're not going to talk about alternative investments. We will have a show on that. This is the investments that most people do to save capital. So if you want to watch this video at a later stage, this will be put onto YouTube, onto our YouTube channel. You're welcome to follow us on YouTube, Retire Rich and Happy. You can follow us on Facebook, Retire Rich and Happy, or you can go to our website, retirerichandhappy.co.za, and chat with us there. Also, if you are listening, you have any questions, please give me a shout out so that I just know you're there, so that I don't feel all lonely here in the studio talking to myself. So let's start talking a little bit about different investment products. Now, there's two specific categories that I want to chat about. The first one is fixed term investments, and the second one is going to be the flexible term investments. So fixed term investments are those investments that you buy from an insurance company or an investment house that is fixed for a specific term. For example, a 5-year term, 10-year term, or until you are ready for retirement, usually 55 and onwards. So the first fixed term investment that I want to chat about is retirement annuities. I mean, all of us have heard about them. We know what they do. But let's get into a little bit of detail about what a retirement annuity is and how it works. So a retirement annuity is an investment that is specifically built to create capital for your retirement. So it is the product in which you put your money so that you build up a capital asset for you to retire at age, whatever age you want to retire at, but usually starting anywhere from age 55. So the first thing you need to understand about the retirement annuity is that you receive a tax benefit for that retirement annuity of yours. So there's a tax benefit, and usually that is where most retirement annuities get sold. They get sold on the tax benefit. The financial advisor, the broker tells you that, listen, it is ideal for you to put this money because the government is subsidizing some of your retirement savings. Now, for me, that is not the major benefit for a retirement annuity, although it is a benefit. So how does the tax benefits work on a retirement annuity? So the law has changed a little bit over the last couple of years. There was a 3-tiered law that was used to calculate how much you can put into a retirement annuity and still claim it back from tax. It has now been simplified to a total of 27.5% of your gross taxable income can be invested into a retirement plan. Doesn't necessarily have to be a retirement annuity. It can also be a pension fund at work, provident fund. But the total contribution is 27.5% of your gross income, with a maximum of 350,000 Rand per year as a contribution. So let's say, for example, you earn 500,000 Rand for the year. You could put away 27.5% of that 500,000 into a retirement annuity and then claim it back from tax. So just quickly chatting about how does the tax benefit work, because a lot of people have a misconception. They think that if they put 2,000 Rand a month into a retirement annuity, which is 24,000 Rand for the year, they will receive 24,000 Rand back from SARS at the end of the year. And that is not how it works. So how it basically works is any contribution that you make towards a retirement fund, whether it is a retirement annuity or a pension fund, will reduce your taxable income by that amount. So I'm going to try and keep this simple from a figures perspective. So let's say, for example, you earn 500,000 Rand for the year and you pay tax at 20%. Now, I know all of you are going to jump up and down and say, I never only pay 20%. I pay much more. It's for me to simplify my calculations because I'm doing this in my head as I'm sitting talking to you. So to make it simple, you earn 500,000 Rand, you pay 20% tax. So that means your tax for the year would be 100,000 Rand. But now you put 25,000 Rand into a retirement annuity. What that means is your 500,000 Rand taxable income will then reduce to 475,000 taxable income, and you will then pay 20% on that. So 20% of 475,000 will then be, instead of, where are we now? 20% is 100,000. That would be about 94,000 something, just over 94,000 Rand that you would then pay in tax. Which means the balance, that 6,000 Rand, will then be your refund that will be paid back to you at the end of the year. So it is not the whole amount. To do the calculation in your head very quickly, take the contribution that you are putting towards your retirement annuity, calculate what your tax rate is, and multiply that by the contribution. So let's say your tax rate again is 20%. You are paying 25,000 Rand into your retirement annuity. 20% of 25,000 will be 5,000 Rand, give or take, that you will get back at the end of the year. Okay, so here's a nice little tip. If you do get that refund, it might be beneficial, but talk to your financial advisor or your broker. It might be beneficial to take that tax benefit that refund that you receive from SARS and put it back into your retirement annuity as a lump sum amount, because that creates an extra tax benefit for the next year. Plus, it is money that you received from SARS for a tax benefit that is again building towards creating more of a capital asset. So that's something that you might want to consider. But there are a few things that you want to take into account. So please talk to your financial advisor before you do that. The second benefit for a retirement annuity, which for me is probably the bigger benefit than just purely the tax benefit, is the fact that your retirement annuity is safe from creditors. So what does that mean? If something happens to you and you get into financial difficulty and creditors start coming after your assets, which I don't hope any of you happens to any of you, but let's say that does happen. then they can attach all your assets. They can attach your vehicles, they can attach your properties, they can attach your cash in the bank, but they cannot attach the money that is sitting in a retirement annuity. So you could have 5 million rand sitting in a retirement annuity and creditors cannot touch that money. And the second thing about that is not only is it safe from creditors, it is safe from you as well, because you won't have access to that money either. So you cannot access the funds in your retirement annuity until you are at least 55 years old. Just another note, a couple of years ago, they changed the law so that if a retirement annuity fund has less than 7,000 Rand in, you are able to access that fund. They have now increased that to 15,000. So if you have an old paid up retirement annuity lying somewhere and you haven't invested into it, you could potentially access those funds before 55 if it is less than 15,000 Rand. Okay, so those are two of the biggest benefits. The first one is the tax benefit. Second one is that it is safe from creditors. But as with anything, you're going to pay your tax at some point. So although you get a tax benefit up front, the proceeds of your retirement annuity will be taxed. So the moment you withdraw, you retire from your fund, there will be tax payable. So always remember, there will be tax. They say there's only two certainties in life: death and taxes. So you're going to pay your tax. Don't think this is going to have no tax implication. Another negative about retirement annuities is the fact that you have limited flexibility with your proceeds. So you are limited to what you can do with your retirement annuity money. When you retire from the fund, you only allowed to take 1/3 of your total amount in cash. And that 1/3 will then obviously be taxed according to the tax rates at that point. The other 2/3 has to be invested into an annuity product that generates a monthly income for you. So this limits what you can do with the assets that you've built up. And we've seen that a lot of people can do much better with their investments in some other vehicle than just putting it into a pure annuity. You also have limited investment choices when you start investing in the retirement annuity. So again, a few years ago, the government came up with the Regulation 28 legislation, and that limits the way that you can structure your investment choices within your retirement annuity. So where in the past you could put 100% of your money that you are paying towards your retirement annuity into shares or equities, for those of you who know a bit of the terms, which is very aggressive and high risk. But usually when you still have 30 years to go for retirement, you can ride that wave, because as it goes up and down, you buying units at high prices and low prices, so you get the benefit of that. But then the government decided that we don't want to take unnecessary risk with people's retirement funds, so they started limiting how people can invest their retirement money. And that's where Regulation 28 comes in. Now, I'm not going to go into a lot of detail about Regulation 28. Again, it's something that you can discuss with your financial advisor or your broker. We will do a video on that at one point as well. But what it basically boils down to is you are not allowed to put more than 75% of your funds into equities in your retirement annuity. You're not allowed to have more than 25% of your funds in properties in your retirement annuity. Combined between equities and properties, you're not allowed to have 90% of your funds in those two funds combined, and you're not allowed to have more than 30% of your funds offshore. So that limits your way that you can invest your funds, which does have an impact on long-term growth. I do understand where they came from, especially with people that only have a few years left until retirement. But the long-term growth for somebody that's only starting out, it does limit the growth that you can potentially receive on your investments. Also, retirement annuities have been criticized a lot because of the high cost of the investment. It is traditionally one of the highest cost investments that you can make from a product perspective. Again, it has changed quite a bit over the last decade or so, where the cost has really been cut down so to benefit the end user. But still, it is one of the most expensive investment products out there. So you can decide if this is something that you feel you want to put money into for your retirement. The second part of retirement annuities is the annuity side of it. Now, a lot of people get confused between retirement annuities and annuities. So a lot of people talk about my money's been put into a retirement annuity to pay me an income, but that's not the same thing. So the retirement annuity is the product in which you save money to build capital. The annuity is where you put your capital to give you a monthly income. So that's the difference. So the annuity is the product that will eventually give you the income. So when you get to retirement age and you want to withdraw or retire from your fund, you can take up to 1/3 in cash. Now guys, just very important to understand that you don't have to take the 1/3. You can access 1/3, but there's nothing that says you have to. So a lot of people just take the 1/3 because they don't know that they're not allowed to. You are allowed to take your whole money, all your money, not pay the tax on that lump sum, and put that into an annuity. And you're basically going to have a choice of two types of annuities. There's other annuities as well, like fixed term annuities, etc., etc. But when you talk about retirement, there's basically two types of annuities that you're going to invest in: either a life annuity or a living annuity. And I know, this lingo gets so confusing sometimes because life and living, it almost sounds like it should be the same thing. So let's first look at a life annuity. So how it works with a life annuity is you have a certain amount of money available, a certain amount of capital. Let's say you have 3 million rand available. You then go to a life insurance company or an investment house and you tell them, listen, I have 3 million rand. I want to buy myself an income for the rest of my life. They then have these actuaries with these big glasses that calculate life expectancy, they calculate rates of return, and they will then make you an offer on how much income they will give you for the rest of your life. So let's say, for example, you take the 3 million rand, they then come back and say, well, we are willing to pay you 15,000 rand a month for the rest of your life. You then say, okay, but what happens next year? Does my income increase? And they will go, no, it will stay 15,000 forever. You say, but that doesn't work because inflation goes up, so I can't survive on 15 in 10 years from now. Then they'll recalculate and they will say, okay, so we will give you an increase every year of inflation, but then we can only start you off with, say, 10,000 rand a month. But now it increases with inflation over time. Then you say, okay, but what happens if I pass away, but my wife still lives? What happens to the income? They say, well, if you pass away, the income is gone. She said, no, but I need to have enough income so that if I pass away, my wife also has income until she reaches or she passes away. Then they go recalculate and they come back and say, okay, so we will give you 7,500 rand a month, growing with inflation until you and your wife has passed away. So what you will see is, as you add more things to this annuity, different lives increases, the amount of income that you are guaranteed goes down over time. The big thing though is The moment you do that, you say, I'm happy, I'll take the 7,500 for the rest of my life, increasing with inflation. The moment you do that transaction, your capital is gone. It is no longer your money. You have now bought that income from the insurance company. So if you and your wife pass away in a car accident 3 months later, the insurance company have paid out 22,500 Rand and they gained 3 million Rand. So they win. If you live to be 120 years old, they're going to pay you more than what you've paid them, and they lose. But it very seldom happens that these guys lose, because the house always wins. So what people need to understand with a living annuity, once that transaction happens, your capital is not your capital anymore. I see it so many times when somebody passes away, the family, the wife, whoever comes and says, but he had an annuity. What happened to the money that we put into that annuity? Well, that money was gone the moment you took out a life annuity. The second option is the living annuity. So a living annuity is you go and you invest your money with an insurance company into the market. So you can choose what kind of funds you want under in your living annuity that you want to invest in. You then choose yourself how much income you want to withdraw from your capital on a monthly basis. So you can choose anything between 2.5% per annum drawn as an income, or 17.5% per annum on the maximum side. So how this works is, if you draw more money out of your annuity every year than the growth on your investments, your capital will start reducing over time, which means you're going to have to draw more of the capital to sustain the income. And then we get into what I call the death spiral, where you take more capital, you can generate less income, which means you have to take more capital from the income, more income from the capital, and that slowly starts deteriorating your capital. And most of the time when people get into that death spiral, it is too late. They can't recover from it. So the risk involved in a living annuity. Okay, let's first talk about the positive of a living annuity. The positive of a living annuity is your capital always stays your capital. It is your money. So if you pass away, that money can go to your family. The risk, though, is if you start drawing too much income from that investment, you can start running out of capital before you pass away and run out of money. The positive of the life annuity is, I am guaranteed this income for the rest of my life, growing with inflation. The negative is, if I pass away 3 months, 6 months, a year later, I have given up all my capital to the insurance company for that income. Now we're going to talk a little bit about endowments. That is the next structured investment that you have access to. So usually when you sit with a financial advisor, a broker, and they start talking about recurring premium investments, they will either look at if it's a retirement investment to put money into a retirement annuity, and if it's a more general purpose investment, you will look at an endowment. An endowment is a savings product that you have a contribution for a specific term, and over that, at the end of that term, the money then is available to you. So the first benefit of an endowment is that the proceeds of your endowment is tax-free. What that means is whatever the value in your endowment is what is going to be paid out to you. It is not going to be taxed first and you get the balance. So when you look at it being tax-free, again, then the not a problem, but what you need to understand is that your contributions aren't tax deductible. So it always works like this. If you get a tax deduction on contributions, your proceeds will be taxed. If you don't get a tax deduction on contributions, your proceeds will be tax-free. You are allowed to put beneficiaries on an endowment, so you can basically direct the investment product who should get the proceeds in the event that you pass away. So let's say, for example, you are married and you pass away, you can tell the endowment to pay the proceeds to your wife or to your husband. There's also a second life assured. Now, even though it's an investment product, that investment product still have a life assured. Although, and a lot of people get confused with that, they say, but there's no risk benefit on this endowment. Why do they call me the life assured? The life assured means who is the person whose life is linked to this product. If that person passes away, the product will cease. So with an endowment, you can add a second life assured. So for example, let's say you take out an endowment for 10 years for your kids' education, to start saving up some money for your children's education. You can add your wife as a second life assured. So what then happens is, if you had to pass away, your wife can just continue with that investment for the rest of the 10-year term. The problem is, if there is no second life assured and you pass away, that investment has to be paid out. So it cannot be continued. Now, it might be that we are sitting in a lull in the market, or the market has reduced dramatically, like we've seen with COVID over the last couple of months, where the markets have collapsed. And you need time for this to recover again. But now you have no choice. The money has to come out at that specific point in time, which is not ideal. Or in the case where it's an investment that you've taken out specifically for a child's education, and that policy has to run until your child is 18 years old. Now the money has to be paid out, which means it has to be now reinvested into a new product, which incurs more cost. So I always suggest that if a husband and wife decides to invest in an endowment product, to put both of them on as life assureds on that product. This doesn't have to be part of your estate. Because you have a beneficiary on, it will not be calculated as part of your estate for estate cost. So if you have your endowment, it can be separate to the estate. So when they calculate what the executor's fees needs to be on that estate, it is excluded out of that, which saves you some executor's fees on your estate as well. There's also some insolvency protection. Now, where a retirement annuity is completely protected against creditors, an endowment product has insolvency protection built in. So a lot of people, when they look at endowments, they say that you should never take out an endowment longer than a 5-year term, because then the cost increases. And if your child only goes to university after 15 years, still do it for 5 years and just then continue with the payments, because then at least you don't have a lot of upfront cost. But the insolvency protection covers you for 5 years after the end of the initial term of that investment. So let's say, for example, you have a 5-year term investment, but you only actually need to access the funds 15 years from now. 10 years down the line, you get into financial difficulty, your insolvency protection has fallen away, which means creditors can now attach your child's education funds for any debt that you might have. So if you need the money only in 15 years, choose to make it a 15-year term, because then you will have insolvency protection on that investment until for 20 years, which is ideal. You've got a lot more investment fund flexibility in an endowment against a retirement annuity, for example. So there's no limits to how you can structure your investment funds underneath. Now, this is just something that I want people to understand, and I see this quite a lot. Guys, what you need to understand is whether you have a retirement annuity product, whether you have an endowment product, the company with which the product is held is only the portal into the market. You can potentially, through one company's retirement annuity, invest in any of the other company's funds. So if a financial advisor or a broker comes to you and says to you, listen, company A's investment is not doing well, I suggest we make this policy paid up or pay it out, and we move this investment to company B because they are giving you better returns, 99% of the time that is in the advisor's interest. It is not in your best interest. because you're going to duplicate the cost first and foremost. And secondly, you cannot buy the time back, because time is your biggest friend or your biggest enemy when you start investing. So that compounding effect that you have, you want to keep going for as long as possible. So let's say you are with company A, but company B's returns are better. You can rather do a fund switch inside the existing product in any case to give you access to company B. You don't have to move your whole product to company B to get access to their funds. So guys, I see that quite a lot, so please be careful. And again, if you need any advice or you've been approached by somebody that suggested this to you, you are welcome to contact our offices. One of our investment specialists can look at it and guide you and tell you whether it is in your best interest or not. Okay, the product will be taxed internally. So again, there's only two certain things in life: death and taxes. There will be tax payable, but you wouldn't necessarily see the tax. It will be taxed internally to the product. It is taxed a little bit higher, at a higher rate than a retirement annuity internally to the product, but you will just see a lower net return. So let me explain. So let's say, for example, you are in a specific fund through a retirement annuity and into that same fund through an endowment. Your net return on your investment on your retirement annuity might be 9%, but your net return on your endowment, you will only see 8%. So you will get a higher return on the retirement annuity because the endowment will have a little bit higher tax internally to the product. You also have the option of having lower premiums for every fund that you want to invest into your endowment, which gives you even more flexibility. Okay, again, it is quite an expensive product, not necessarily as expensive as a retirement annuity from a fund and a product perspective, because of the terms being much shorter. So the shorter the term, the less the fees are that you will pay on this. So it will be less expensive to invest than a retirement annuity. Okay, then the next one, it's something that a couple of years ago got onto the market, and a lot of people still don't exactly understand how they work or what the benefits are and the problems are with them, and that is tax-free savings. So a tax-free savings is a product that the government launched that says you can save into the market and you will pay no tax on the proceeds. So as an endowment gets taxed internally, as a retirement annuity gets some tax internally, on a tax-free savings there will be no tax payable on your proceeds. So a lot of people have started putting money into tax-free savings because there is some benefit on it, but they don't 100% understand where tax-free savings fits into their whole investment portfolio. So the first thing you need to understand is that you will have maximum contributions that can be made into a tax-free savings. You can't just put in as much as you want. You cannot put in more than 33,000 Rand per annum, per year. You cannot put in more than 33,000 Rand into your tax-free savings, and you can never put in more than 500,000 Rand in your lifetime. So if you look at that, that's about 33,000, about 15 years before you will reach the 500,000. So the first thing you need to understand is that this should be always viewed as a long-term investment, at least 15 years and longer. It is not something that you want to put money into and withdraw in 2 or 3 years. So if you are saving for your child's education or you're saving for a holiday in 5 years, a tax-free savings account is not the right way to go. A tax-free savings account is an extra over and above your retirement planning that you're already doing. The reason for that also is that your true benefits from the tax-free returns will only happen once you get to the 500,000 Rand mark, because it's only on the returns on the investment, and with compounding interest, the returns initially will be so small that it will be negligible, the benefit that you get. Once you get to after 15 years, you've put in your 500,000 Rand, then the returns will be substantial, which will give you some benefit for there. So it should always be viewed as a long-term investment. The second reason it needs to be viewed as a long-term investment is because you only have one opportunity to put that money in. Let me explain. You can never put in more than 500,000. So if you put 33,000 Rand in this year and you withdraw it next year, you don't get the 33 that you can put back again. You've already put that 33,000 Rand in. You can never put it in again. So you will never then reach the 500,000. So again, it's an investment that you want to put the money into and leave there. You don't want it to access that money. So this is not a rainy day fund. It's not an emergency fund. It's not a 5-year fund to save for a holiday or a new car or anything like this. This should be viewed as a long-term fund specifically for retirement. Another thing you need to look at is, I see this quite a bit, especially with people who work in companies that offer them these tax-free savings. Do not invest in fixed interest funds through your tax-free savings. You should be willing to take more risk with your tax-free savings, because interest is already tax-free up to 23,800 rands per interest per annum. So if you start putting money into your tax-free savings and you're getting fixed interest like a 6% in a money market fund or an income fund, that interest would have been tax-free in any case. It is pointless to have it in a tax-free savings. So you want to put your money in a tax-free savings into funds that you would have paid taxed on, like equity funds, like gilt funds, those kind of things. Okay, so if you are under 65, your interest that you receive from your investments is tax-free up to 23,800 Rand per year. And if you are over 65, your first 34,500 Rand per year is tax-free. So don't invest in fixed interest funds from your tax-free savings. Also be very careful of the cost and how the cost is structured. If the cost is paid out of your fund, that will reduce the amount that you can put into your tax-free savings. So if you have the cost on your tax-free savings, make sure that they deduct the cost before your money goes into your tax-free savings and not out of the savings. Because the cost that then gets paid out of your fund is almost like a withdrawal that is made. So every time you withdraw, remember, you can't put that back in again towards your 500,000. And then also look at the accessibility. A lot of these funds are accessible, but you do not want to access that funds for at least the first 15 years or so. Look at the time. It is 10:53 already, and I still have about an hour's worth of talking to do. So unfortunately, we cannot extend it for another hour. So we will finish this conversation next week. So what we're going to talk about next week is flexible term investments. So we've now spoken about fixed term investments, where you take out an investment for a specific period of time. We are now going to look next week at flexible term investments, where you start investing money. You don't have a fixed contribution every month, or you don't have a fixed term that you are investing for. So we're specifically going to talk about unit trusts. We're going to talk about exchange traded funds, how they work, how they differ. Just a few final thoughts before I say goodbye today and we play out with a song. First and foremost, on endowments, please remember that your endowment product has a minimum term of 5 years. So in your first 5 years, you are limited to the access you can have to those funds. So if you put your money in 3 years later, you can only withdraw once, take a loan, or surrender it once. Otherwise, the money will be fixed for the rest of the 5-year term. After 5 years, it becomes open-ended, and then you can have access to that fund at any given point in time. Just a quick thought on life annuities. Before I do that, let's talk about the tax-free savings. a good idea if you do want to start investing in tax-free savings, specifically if you want to start saving an asset for your child's education or your child's retirement, is to take out a tax-free savings for your child on their name. Because if they are born, you take out a tax-free savings, you put the maximum 33,000 Rand per year into that tax-free savings. By the time they are about 15 or 16 years old, you would have reached the 500,000 Rand lifetime investment. And then for the next 20 to 30 years, you can get all of that compounding interest for your child tax-free. That is where the true power of it lies, is the compounding effect. It is not in the short term by putting in money and getting a return on 30,000 Rand and thinking that's going to make a difference. Just a quick thought on annuities. When you do have a living annuity, when that fund reaches, I think it's something about 70 odd thousand Rand at the moment. I think it's 70 or 140, I can't remember exactly, but there's a specific limit. When your living annuity reaches that limit, you can actually access the whole amount and withdraw the balance of that annuity. With a retirement annuity, if the funds in your retirement annuity by the time you retire, you are 55 years old, is less than 247,500 in that fund, you can access the whole amount. But to be honest, 247,500 is not going to make a huge dent in your retirement. Okay, guys, thank you very much for joining me. Again, if you have any questions, you are welcome to email me directly as well. It's Lourens, Afrikaanse Lourens, at retirehappy.co.za. So Lourens, Lourens, at retirehappy.co.za. That is my personal email address. You are welcome to send me a question on there. You are welcome to contact us through our website, retirerichandhappy.co.za. Follow us on YouTube, Retire Rich and Happy. And please subscribe to our channel. The more viewers we have, the more exposure we get with our videos, which means more people can see this content. And then also follow us on Facebook, Retire Rich and Happy. Guys, thank you very much. Enjoy the rest of the week and the weekend. And I will see you, or hear you, or listen to you, or speak to you, however we want to say it on the radio. Talk to you again by next week, Thursday.